George Salamis, President and CEO of Integra Resources. Integra Resources is in the process of developing a very large gold-silver project in southwestern Idaho with 5 million ounces of total resources.
George, thanks very much for coming on the show, and thanks for picking up the phone to answer our questions. Last time we spoke, PFS came out. You were quite pleased with it. Market didn't like it so much. It looks like you feel you needed to recoup the situation somehow. You seem to have put out some simplified strategy document here. Why have you done that?
Matt, so essentially what happened was we put out a PFS during the peak of inflation, right? The very first study of the year by a pre-development company. We took our licks for it. I felt that a lot of the investing public didn't quite understand, the measure of inflation that occurred in this study, and were confused. And so we took a.
But George, that's on you, not them, right?
That's on us. Correct. That's on us. Absolutely. From a timing perspective, could not have been a worse time to put out a PFS study that showed a lot of inflation, right? In there. So in our soul searching measure that we employed to basically drill down to what is the core of the project. The core of the project really is the heap leach. It's the financial engine of the project relative to everything else. It accounted for 3/4 of the net present value of the project in the end of the day. So we've taken the decision now, before we start permitting, before we stick a shovel in the ground, to focus just on the heap leach, because it is that financial engine. We can develop this project with much lower CapEx. It lowers OpEx. It lowers permitting risk. It lowers financing risk. It lowers execution risk. And why not do this right now? We're taking the decision that this is the right thing for the shareholders right now in these inflationary times.
Okay, you keep mentioning inflationary times, George, but right. And your PFS, I think you were one of the first companies to actually sort of include sort of real world numbers in a PFS. Yeah. Perhaps you say timing was not your friend at that point, but I suspect there'll be more companies having to step up and produce some studies to include those numbers. Can we expect to see more of the same out there in the marketplace? Do you think that that's the reality of where we're at?
It's the reality of where we're at right now, and understand that this isn't a knee-jerk reaction to that. This is a combination of two things: sort of responding to the inflationary times that we're in, but also targeting a project that's much lower risk from a development and execution perspective, financing perspective, just for a myriad of reasons. This more simple project build that will produce about 136,000 ounces a year of gold equivalent is the right thing to do right now. We can always look at mill expansions later on, once the project is up and running and cash flowing and doing all of those great things. For now, this is the right project to permit and develop for Integra and its shareholders. There's no question about that.
Well, made all the more difficult with the fact that you've been on a slide for the last 12 months, down to $100 million market cap. It's hard to get finance when you're showing that kind of trajectory, not without it costing you a lot of money. So give me some of the numbers. Give me some of the savings. I need to believe that this is a better solution and not just another solution.
So some of the sort of key metrics that we're looking at in terms of numbers. So as I mentioned earlier, 17% reduction in all-in sustaining costs. That's a pretty significant drop, down to $813 an ounce all-in sustaining. That's a great margin. Doesn't matter what gold price that you want to use in your price deck, right? So that provides surety of payback, and it reduces the time to pay back. All of those key things that financiers will look for. One of the sticker shock factors of the PFS that we put out 6 or 7 weeks ago was the capital, the inflation that crept into the capital. I would love to say that there was something that we could have done about that. I would love to say mea culpa for that inflation. There's nothing we could do about that. So how are we dealing with it? Well, we're chopping off about $235 million from the total CapEx of the project. So very substantial amount of capital reduction. I think from a financing point of view, that should add confidence and security of payback to future financing.
Okay, so we'll talk to me what it looks like. Okay, heap leach, that's the way forward. You can talk about mills and so forth at a later date. I get it, possibly when you're in a cash flowing position. That's a very, very different type of financing arrangement for that. So heap leach, the heap leach will deliver you 136,000 ounces a year? So we saying?
That's correct. Yeah.
Okay.
That's the average production level for the project as we're proceeding forward with today. It'll generate over $100 million of cash flow on an annual basis. So, a really strong project and not complicated to build. That's another thing, right? The execution risk on this relative to say adding on a mill is an order of magnitude of difference. In terms of the initial capex that we're looking at, we're looking at a 10% reduction of initial capex, but sort of a whopping sort of $225 million less sustaining capital to add onto the project. Funds that were originally earmarked to go from the heap leach to build the mill is no longer going to be the case for now, right? We can make that decision in the future once we're up and running, once we're happily sort of producing a lot of gold and silver and generating a lot of cash flow. Under the right conditions, we can relook at that sulfide processing optionality. But for now, this is the lower cost project to build.
Okay, so let's keep it really simple here. You're going to need how much capex to get the heap leach program running? How long is that going to take? Where are you with permits, licensing, et cetera, in terms of the delays that may occur? I want to know when you get into production. If you're talking 136,000 ounces, I want to know what that ramp up is, because the AISC of $800. I mean, wow. What's it going to cost you to get there, though?
So the pre-production capex for this project to get us there is $270 million, which includes 20% contingency. And let's sort of, bear in mind that the costing for this project was done at what might be the peak of inflation. You mentioned it earlier, Matt. This was done. This was a project that was costed out in January. I mean, things could not have gotten worse from an inflationary perspective. From our point of view, supply chains were squeezed, costs were squeezed. We saw, 65% inflation in things like earthwork, steel, 35%, cement, 30%, things like that. Is it going to get worse? Who knows? I don't know. I can't predict the future. But all I'm saying is we're responding to that with a lower capex scenario that gets us into a really decent range of production in the end of the day. To your question regarding permitting, and let's kind of start from scratch, because this is all about permitting, financing, development, and execution, right? So from a permitting perspective, relative to what we were contemplating earlier, permitting just a heap leach is far easier. We're talking about less surface acreage of disturbance because we're not talking about big milling operations, big tailings facilities for now. We're talking about using about 60% less water. Water is a big thing in the context of U.S. permitting. Water usage is huge in the Western U.S. and the permitting authorities want to know about that more than anything else. If we're now contemplating something that's going to use 50-60% less water, that makes permitting easier. From a milling perspective, really clear, right? So the mill is designed to treat sulfide. When you treat sulfide, there's a component of potential acid generation which comes with that. If we're no longer contemplating milling for now, we can revisit it in the future once we're up and running. But for now, that makes our permitting iterations much easier. Power usage goes down significantly in the absence of the mill as well. So from a permitting perspective, it makes a heap of sense.
Right. So that's lower permitting risk, lower development risk, because you're not building a mill. So that speeds the whole thing up. So come back to the important question for me was, how quickly can you get through that process and get into cash flowing position? Because 136,000 ounces, whatever that ramp up period is, I'm very interested in that, because when we're looking at some other producers out there, when you're getting near producing 100,000 ounces a year, you're a $500 million company. You're currently a $100 million company right, with not too expensive capex or sustaining capital to kind of get you there. So I'm interested, but I want to know how long that's going to take.
So from a permitting perspective, we're still estimating about 3 years. And despite the fact that we're cutting out a lot of from the permitting work that we have to do because we're not focusing on mill construction at some stage in this current permitting iteration, the work that goes into permitting is the work that goes into permitting. So I would love to sit here and say we can shave half a year off the permitting iteration, but for now let's just keep it at 3 years, and I'm going to be conservative in saying so. It's the work that goes that goes into the scope of the project that is vastly reduced. The cost of permitting is going to be reduced because we're not looking at a big milling situation. We're not looking at, massive amount of condemnation drilling to drill off, say, a plant site or a big tailings facility. All of those things, they really add up. The fact that we're not generating, potentially acid causing, tailings and waste is a big number. In permitting, again, we don't have to go down that road for now.
Right. So permitting process is another 3 years, presumably another couple of years to kind of get up to optimum. Well, you tell me, come back to the question. When does this thing actually start producing gold?
So let's talk about, beyond the 3 years of permitting. Let's just assume we get our record of decision having gone through a fairly easy period of permitting iterations. To ramp up to capacity in the heap leach, it doesn't take long. We estimate about a year to get to full capacity on that note. But again, so let's now contemplate, in the absence of a mill, what that looks like. Instead of going from building the heap leach, having it running for a period of a year, then contemplating another expansion straight out of the gate, we're not talking about that anymore. We're talking about collecting the cash flows from this heap leach operation, paying down debt, whatever means of financing that will be employed to get there to the finish line, and not plowing them into a $250 million mill expansion. Instead, quickening the payback of the project, and then you may be using those funds to expand the heap leach. We think that there's a lot more oxide that can be added to the heap leach mine life if we're talking about just a heap leach alone. It just adds a whole reduced level of complexity when it comes to financing. If I was a financier, for example, I would say, okay, you're building a heap leach and you're building a mill within a year. Wow, that's going to extend my payback out into the future. All that free cash flow that you're generating from that heap leach, well, you're plowing it into a mill. So I'm not too sure about that. Whereas if we're just focusing on a heap leach that's going to be generating $100 million a year of cash flow, pay down the debt, use that to expand the heap leach, use that to continue growing the resource base beyond 5 million ounces. And then at some stage, when the conditions are right, then maybe you look at sulfide expansion, mill expansion, high grade production, all of those things. Let's just focus now on what's simple and easily attainable.
Right. So you reduce cost, you simplified permitting and development, cost of money when you get to that point. Okay, I get that. But the time frame, that's going to be, because what I want to ask you is why should people invest in you? Because we're talking 3 years permitting and maybe another year to get in production. We're 4 years out from cash flow, free cash flow, $100 million a year. I like it. That's over what? So 8 years it's indicating here. Is that right?
Correct.
Okay.
Yeah. So why should people invest in us today? I mean, there's a couple of no-brainer points there, Matt. One of them is standalone heap leach operations in let's just call it North America are pretty rare in terms of those that are owned or not owned by major producers right now. This will be one of the largest ones out there. And on a comparable basis, if you look at our 3 or 4 other comps out there, they're all trading at 2 to 12 times our current value. There's a big value discrepancy that I feel probably was caused by when we put out the PFS. No question about that. The ambiguity regarding what it is, what kind of project we're going to build. We're getting rid of all of that crap right now. We're just drilling right to the bone. This is what we're going to do. Easily permittable, easily financeable, gets us to a good production range. And if you look at us on a relative valuation basis, that there's a no-brainer gap to be made up. That's point number one. Point number two is we've got a lot of low-hanging fruit on this project in terms of oxide upside. And we've done our internal calculations. What are the best ounces for us to find for now? The best, easiest ounces for us to find and add to future mine plans are the oxide heap leachable ounces. They're cheap, they're easy to find, they're near surface. We know of at least 3 areas where we've got something that looks like 500,000 to 1 million ounces of oxide heap leachable potential. Think about what that looks like when you start to add that on to 8 years of heap leach mine life. Now you're talking 10, 12 years of potential heap leach production. And I'm not even talking about sulfide production now. I mean, sulfide can be our problem or somebody else's in the future. We're just dealing what's easier and more manageable for us right now, what's more manageable for us and our shareholders right now. And that's the heap leach.
Okay, fine. I get the laser focus on what makes sense or where the bulk of the money is to be made. I get it. Okay, and the time frame is the bit that I still come back to, right? Okay. Which is, and you can go and find some oxide near surface, at surface, may add 500,000, 1 million ounce on those. Times 3, extend the life of mine. That's brilliant. But you're also going to need some other stories to kind of keep this of interest, right? Yeah. And that can be through the exploration that you're talking about with the oxides, or it can be doing other things on other properties. And my question is, how do you finance that? Just to kind of keep and sustain interest and growth as part of your story.
Okay, well, so maybe it kind of it behooves us at this point to talk about our exploration track record, right? What we've done. We started out with this project 4.5 years ago with 0 resources and reserves. Our first resource estimate that came out was, I believe, 2.5 million ounces. The second one was 3 and change, and we're now at 5. Right, so we've got a great track record of exploration success. It costs us, relatively speaking, about I think it's the latest figures around $10 an ounce to find an ounce in the ground with our drilling programs. Our shareholders know one thing about this project: it's a big area, and there's a lot of exploration potential. I mean, Florida Mountain, for example, is a great example. We've been putting out high grade results there on a project. We believe 500,000 to 1 million ounces of high grade is easily attainable. It's going to require more drilling, no question about that. But none of that has even figured into any element of any study whatsoever, be it a resource estimate, be it an economic study. So there's that to wait for as we march ourselves into production. There's that exploration upside optionality. And in the background, obviously, with respect to the sulfide portion of the 5 million ounces of resources that we have, we can work in the background to improve sulfide recoveries substantially. Not to say that we're going to focus on any form of development of those sulfides for now. Maybe at some point in the future when we're cash flowing and in operation and everybody's happy. Yeah. But in the background, we can do things to optimize sulfide recoveries for us or somebody else at some point in the future. And so there's all that optionality on the project, which hasn't gone anywhere. We haven't given up any value whatsoever in this new strategy. That optionality remains preserved, and we'll be poking away at that optionality over the course of 3 years while we're in permitting mode.
Right. Okay. But you get my point here. It's a long point till you get into cash flow. You've got a bunch of ideas which you've now talked about being able to do, which may create some value, or certainly be able to talk about a growth story, add some ounces, albeit possibly inferred. But all the while, no revenue coming in, possibly raising capital, burning through capital, big G&A. People would be nervous about that. So that's why they're looking to you and going, okay, I would say what I've heard from you today about your plan about just getting down to the bare bones of it with regards to, the mixed oxide resource expansion stuff, brilliant. But we're sitting around waiting for permitting to happen. You're doing a bunch of stuff. It's all going to cost money. Is this just a dilution story?
So from a financing perspective, and it's a question that comes up, and let's kind of first tackle G&A, right? There's a conception with respect to the investing public out there that our G&A is high. What people need to dive into on those G&A numbers is our G&A also involves site maintenance. We inherited this site from Kinross as a past producing operation. We have an obligation as stewards, good stewards of the environment, good corporate citizens, to maintain that. And there's a cost to that. And the cost is, $2 million is just for the work that we need to do to maintain the site, right? But that's a fixed cost. But it's part of our site G&A, which figures into our overall G&A. There's the staff on site that need to do that. That's all fixed. But that's the cost of doing business on a 5 million ounce gold equivalent asset out there that will become a very stellar heap leach, in a short amount of time, in the next 3 years. That's our belief. In terms of how to finance next, and I know it's a big question that comes up, 100 million market cap, the finish line's 3 years away. How the heck are you going to get there? How are you going to finance it? Understand that, again, with this strategy becomes, we believe, a reduction in the cost of capital, right? If we're talking about a project that's going to cost less to build, less to produce, that makes our financiers happy, yeah, or we hope, and gives them the confidence that we're going to get to the finish line. Cost of capital increases, dilution decreases. Again, another couple points here. We've got a lot of buttons to push to from a financing perspective. 5 million ounces of gold equivalent in the ground, 120 million ounces of silver within that, right? Lots of things you can do with that. At some point in the future, you can look at streaming options. You can look at royalty options, things like Florida Mountain, for example, which is really the big driver of economics of the project, has a zero royalty load on it currently, right? So there are things that we can do on that end as we get closer to the finish line to minimize dilution. And that's the way we see it. I would love to say, hand over heart, Matt, that we don't need to raise a single dime between now and the finish line. Yeah, but no, that's not the case. But so far, our track record of raising money has been very successful. And, do we have to raise money right now? No, right? And we're going to pick the optimal time. That's one thing that Integra has been successful at doing, is picking optimal windows to raise capital. We did it at Integra Gold. We're going to do it again, or we have been doing it again at Integra Resources. No different this time around.
What do you think the thing is that's going to drive the share price back up to a point where you think, okay, this makes sense to raise money at these values, or I can achieve a premium to today's price because of what I have done? Is it this statement of intent today? Because, this is I don't know how firm these numbers are. I don't know. Can you put a marker in the sand and go, right, we stand behind the numbers which we're putting out to market here? Where have these come from precisely?
Yeah. So for the regarding the firmness of these numbers, they come straight out of a PFS that was delivered, 6-7 weeks ago. A study that was costed in January at, the very peak or the summit maybe of inflation and supply chain constraints. So you'd have to, expect that these costs are really real. And so we're, in a project where we're talking about 72% less sustaining capital, lower pre-production capital to get us to the finish line. Things should be easier. That message should be very simple. We're building a simple project here. We're not looking at kicking a goal straight out of the gate, right? We're going to get there in steps. And that first step is the easiest one in our view. The lowest risk one in our view is to start off with this heap leach.
So why didn't you do this out of the gate? Why did you go for the milling route? What was the benefit of that?
So, one of the things that we looked at over the course of last year when, inflation wasn't exactly an issue. We were very much of, let's stay the course and look at the dual scenario of a heap leach plus a mill. It wasn't until the end of last year, early this year, that we had the holy crap moment. Inflation is a thing here and it's real. And how did these costs get to where they are? Well, they're real costs and it is what it is. Nothing we can do about that. But by that point, we had gone so far down the line with this study of showing the combined scenario. We thought, okay, our shareholders will get the optionality of heap leach or heap leach plus mill. Maybe that was ambiguous for shareholders. So today, what we put out is an unequivocal statement. The heap leach is what we're building. It's lower CapEx, lower OpEx, easier to permit, easier to finance, all of those things. Our shareholders were saying, show us the direction you're going in, and this is it.
Okay. I think, I suspect you took one for the team back in back in March with the PFS and sort of showing what the actual real world effects of inflation is going to do to the mining business. And quite a few people who were putting out studies decided not to for that reason. But look, George, I appreciate that you coming and being, fairly robust with your response. And I think the plan makes a lot of sense, and it certainly will. As with my banking hat on, it makes a lot of sense that you go down this route. I just kind of, I hope the market reacts positively to it as well. And what if I let you have the finishing word here? How should, I know institutions will get it because the numbers stack up. What would you say to retail investors?
I think the retail investors will focus on two things. Obviously, hopefully they'll like the vastly reduced CapEx and OpEx that we're talking about. Hopefully they'll get the reduced permitting burdens on us with this heap leach standalone strategy. What I really hope that they get and understand is the upside potential and optionality of this project, which is still preserved in this scenario. It hasn't gone away. We haven't lost any value on the optionality, on the exploration upside. It's still there. It's not going anywhere, and we'll continue to make it bigger as we march through permitting. We're never going to stop exploration. We've got something between 15 and 20,000 meters of exploration planned for this year alone to go after, several areas of what I call low-hanging fruit, and we'll continue to poke away at Florida Mountain from a high-grade perspective. So that none of that is gone. You've got 138,000 ounces a year, 136,000 ounces a year of heap leachable low-cost production, and you've got all this exploration upside optionality, which is preserved.